Good evening to you at this hour on the business desk. Global markets are looking ahead to economic data releases and the Federal Reserve's policy review this week. This has prompted a risk-on sentiment. Meanwhile, Asian stocks are upbeat with a surge in the yen and equities looking set to continue into Europe. Gold prices, on the other hand, have fallen on diminished hope of a U.S. Federal Reserve rate cut. At the same time, oil prices have dropped by over 1%, partly due to ceasefire talks in the Middle East conflict. Portfolio Manager Phaswane Mphahlele discusses the day's markets with us. Thank you so much, as always, for your time. Phaswane, what drove activity in today's session?
Good afternoon to Misang and to all your viewers. Well, today we continue to see global markets trading higher, supported by some of the robust U.S. earnings and developments, the renewed efforts around the U.S. trying to get a ceasefire in the Middle East. That has helped some oil prices to remain kept and very far from higher prices such as 90, which has increased the risk sentiment to trade higher. And we also saw the fact that we saw a positive rebound in terms of the global industrial activity. And this is supported by how it is expected coming from tomorrow's data. Whether you look at Europe or the likes of China that had been trading something that looked like a recession, and the demand in electrification has also improved the spillover effects of positivity that would happen in the commodity space, whether you look at M&A or just the general prices of commodities going higher. And however, we've seen that our gains were slightly kept, and this is at the back of the fact of we're having a US Fed policy interest rate decision meeting later on this week.
Now, is this the expected tone for market activity throughout the week?
Yeah, it is expected to hold such a tone throughout the week until we get at the outcomes of that meeting and what it holds in terms of what the Fed is saying, whether they'll be on the hawkish side or not.
On the back of that, Phaswane, the performance of the rand, we saw it gain some strength but somewhat lose that momentum along with emerging market currency peers. How is that front performing?
Well, having to have seen the development of the dollar having weakened, because the implied volatility right there is lower because of we've seen what we've seen is more of a ceasefire type of development taking place. We've seen the implied volatility around the dollar is weaker, and at the back of the fact that we've seen that they were expecting a higher for longer environment coming from the Federal Reserve because of higher bond yields that have been priced in based on the data that have been coming in. The dollar has shown some slight weakness. Emerging markets have been mixed, and therefore we've seen the likes of the UN being weaker today, the Chinese yuan being weaker today around 7.2. But that's just the effect of a more closer story in terms of Asian currencies that are going through a lot at the back of the Japanese yuan being weaker and affecting their currencies. However, but when we look at the likes of the Brazilian real, we've seen some strength there up to 5.1, the 5.1 level against the dollar. And that's off the back of the fact that their central bank has been coming in with some positive development in terms of the GDP growth expected to be around 2%. They are going to be delaying interest rate cuts because of the sticky inflation. The Indian rupee, it remains in range bound, and this is at the back of the fact of that Fed meeting that is coming up. It is largely expected that they would not issue out any interest rate hike changes to it. It will be unchanged. The key issue would be around that commentary. What will they be saying? And based on the data that is coming in, we expect them to be very hawkish, and that will therefore reflect a higher for longer environment. Looking at the South African rand there, it has done much better than some of the major market currencies today. It sits around 1863, and that's at the back of the weaker dollar because implied volatility is not there to looking forward, and they've therefore further on benefited from the higher commodity prices that have rebounded. They're benefiting from the fact that the global economy is rebounding, including South Africa's economy is taking a spillover effect.
That's encouraging to hear.
Rebound, and we'll get to see positives. Around our positive trades of terms. And when we take on the general risk on mood today, we see investors are just happy. Whether you look at our equities up 1.3 and our bond yields are giving lower around 10.9.
Let's also then dig deeper into what would be expected from the US Fed. We got our own review from the central bank just last week, and not much of a changing picture, especially at an accelerated level. So from the US Fed, what is the market expecting, the nitty-gritties of what is likely to be or become of the global economy?
Well, if we look at it following last week's recent data, we've seen it's been pointing towards a higher for longer environment. Whether you look at growth spending or you look at inflation, we've just then end up seeing the influential bond market in repricing bond yields higher to reflect this environment, and that's therefore that tells them that one, interest rate will not be changed coming in tomorrow. Two, the other indication would be that we expect the Fed to be rather on the hawkish side. And this is at the back of them also being very credible and trying to reflect the re-inflating situation we are faced with, whether you look at it from inflation or a growth standpoint. And an impact of that from coming from the U.S. as the the de facto leader in terms of monetary policy would mean other economies would also want to therefore try to be somewhere closer to what the Fed is actually doing, because we're in a global economy. Things are competitive, and what we're looking for is capital inflow. So they will be also trying to be on the better side of things, to be very higher for longer, to determine whether it would be the right time to cut. It would not be immediately until the Fed does something. And guys, it's not necessarily bad that we'll have higher for longer environment. It's just a reflecting that global economies are re-emerging into a higher regime. And this comes from the back of what has happened to us during COVID, the supply chain impacts, the monetary policy easing that was done in order to support the global growth.
Thank you so much for your contribution as always. That is Phaswane Mphahlele, Portfolio Manager at Makwe Fund Managers, talking us through all the market developments of the day.